Something huge is shifting behind the scenes of the global financial system, and almost nobody watching mainstream headlines understands what it really means. While everyday investors argue about meme stocks and interest rate cuts, the people who actually run the system, central banks, are quietly making the biggest portfolio change since World War II. They're not tweeting about it, they're not doing CNBC interviews, they're doing something much louder, if you know how to read it. They're dumping US debt and scooping up physical gold at record speed. In just a few years, they've doubled their average annual gold buying and driven the dollar's share of global reserves to its lowest level in decades. They're not speculating, they're repositioning for a different world. A world where the dollar is no longer unquestioned king and where gold isn't a relic. It's back at the center of the game. The date circled on their models? Around 2027. The only question is whether you'll still be thinking in the old system when the new one arrives. If you want to know where the global system is headed, don't watch influencers. Watch central banks. These institutions move slowly, deliberately, and only when they're sure. So when they start buying gold at a pace we haven't seen in generations, you should assume they're not guessing. Over the past few years, official gold purchases have exploded past their long-term averages. What used to be a few hundred tons a year has surged into 4 digits, and it hasn't been a one-off. We're now seeing the third consecutive year where central banks are adding roughly a third of all freshly mined gold to their balance sheets. That's not diversification, that's repositioning. At the same time, the dollar's share of global reserves has slid into the high 50s, its lowest point since the mid-1990s. Keep that trajectory going, and the US currency slips below majority status within a decade. Central bankers see that path and aren't waiting for the final milestone. They're acting now, quietly rewriting what backs their currencies and how they'll survive the next phase of this experiment. The smart move is not to argue with that signal, but to understand it. Look at how different countries, often with very different politics, are suddenly following the same script. China has been methodically shrinking its exposure to U.S. Treasury bonds while steadily adding to its official gold stash month after month. On paper, the numbers look big. Off paper, serious researchers estimate Beijing may already hold more than twice the gold it publicly admits. You don't accumulate that much metal while cutting your holdings of U.S. debt by hundreds of billions unless you're preparing for a different monetary landscape. Then look at Poland, a mid-sized European nation firmly plugged into the Western system. Its central bank has been one of the most aggressive gold buyers on earth, pushing its gold share of reserves above 20%. And they're not coy about why. Polish officials have openly described gold as a pillar of security and stability in an uncertain world. From Eastern giants to European mid-powers to emerging markets, the pattern repeats. Fewer dollars, more gold, stored at home under local control. When countries with completely different interests adopt the same strategy, that's not a trend, that's a survival plan. For decades, holding dollar reserves felt risk-free. You earned a little yield, enjoyed global liquidity, and trusted that your assets were untouchable. That illusion shattered when sanctions escalated from a tool against individuals and companies to a weapon aimed directly at a major country's central bank. When Russian reserves were frozen, something snapped in boardrooms around the world. Finance ministers and central bankers realized that their hard-earned reserves weren't purely economic assets, they were political hostages. A single decision in Washington or Brussels could erase decades of surplus accumulation. From that moment, dollars were no longer just a neutral store of value. They became conditional, usable only as long as your government stayed on the right side of another government's policy. Gold, by contrast, doesn't care who you vote for, who you trade with, or what alliances you break. It can't be shut off by a switch in a foreign capital. It doesn't rely on payment networks or permissioned ledgers. So central banks began to reframe gold in their internal models, not merely as an inflation hedge, but as protection against political risk, against being cut off, against watching reserves evaporate without a single bomb being dropped. That shift in trust is now driving the biggest reallocation of reserves in half a century. The dollar isn't going to disappear overnight. That's not how reserve currencies die. Instead, they erode. Slice by slice, allocation by allocation, auction by auction. In 2015, roughly 2/3 of global reserves sat in dollars. Fast forward a decade, and that share has drifted down into the high 50s. On its own, that might not sound dramatic. But pair it with another trend. Big foreign holders of U.S. debt have moved from being steady buyers to inconsistent buyers, and in some cases, outright sellers. Foreign ownership of Treasuries has dropped from over half of outstanding debt to closer to a third. That means more of America's borrowing has to be absorbed domestically or by its own central bank. At the same time, deficits remain huge, and refinancing needs are exploding as old, low-rate debt rolls into a higher-rate world. Put simply, the U.S. needs more buyers just as its traditional customers are stepping back. That mismatch doesn't cause a crisis in a single day, but it ratchets pressure into the system, raising the cost of borrowing and forcing policymakers into increasingly aggressive tricks to keep the game going. Central banks see that trend line and are quietly getting out of the way. It's tempting to look at recent gold prices and think, it already went up, I missed it. Central banks don't see it that way. They're looking at gold not as a trading asset, but as a share of total reserves. And by that metric, we're still far from historic norms. Right now, official gold holdings account for under 1/5 of total central bank reserves. In the decades after the last major monetary reset, that number was closer to 1/3. Go back further, and gold's share was even higher. That gap between today's allocation and historic normal levels is where the upside lives. If central banks merely move back to their post-Bretton Woods average, demand for gold increases dramatically relative to current supply. If they decide that a world of strained trust and ballooning debt requires an even thicker golden buffer, the required repricing gets more extreme. No wonder major Wall Street firms have quietly lifted their long-term gold targets into the high 3,000s and beyond. They're not just looking at jewelry demand or mining costs. They're running the numbers on what happens when the asset at the edge of the system moves back toward the center. If this were just about price, central banks could buy gold exposure with a few keystrokes: ETFs, derivatives, pooled accounts. Instead, they're doing something far more revealing. They want metal they can touch. We're seeing a deliberate shift from paper claims to physical custody. Countries are repatriating gold from foreign vaults back to their own soil. They're building new, high-security storage, upgrading old bunkers, and concentrating reserves under direct national control. This isn't the behavior of institutions seeking short-term gains. It's the behavior of institutions planning for a scenario where counterparties fail and legal promises stop meaning much. Physical gold has two critical properties in a crisis. It doesn't rely on someone else's solvency, and it doesn't vanish if an electronic system goes offline. Those traits don't matter much in calm times. They matter enormously when currencies are questioned, sanctions proliferate, and faith in cross-border promises thins out. The quiet repatriation and vault building wave sends a simple message. Central banks aren't buying gold to flip it. They're positioning it as collateral, as a backstop, and as an asset they can still use if the rest of the financial architecture has to be rebuilt from the studs. Zoom in on the United States, and the pressure points become obvious. Debt has climbed to levels that would have been unimaginable a generation ago. Interest costs alone are eating a swelling share of tax revenue, and that's before any new crises, wars, or recessions. There are only 3 ways out of that kind of bind: brutal austerity, slash spending and benefits until the numbers line up, risking social unrest; explicit default, tell creditors they won't be paid in full, detonating confidence; stealth default, pay in full, but in dollars that buy less over time. Historically, governments almost always lean on option 3. It's politically easier to let inflation and financial repression slowly erode real debt burdens than to announce outright default or deep cuts. But when the starting point is today's scale of obligations, gradual erosion requires more and more aggressive monetary policy. Bigger balance sheets, lower real rates, constant interventions. Central banks around the world can read those same budget projections and bond math. They know that defending the current system means sacrificing currency strength over time. So they're hedging that inevitability with the one asset that's historically survived every paper money experiment: gold. The idea of a 2027 reset isn't about a single magical date where someone flips a switch. It's about converging timelines that make the mid-2050s a likely tipping zone rather than a random guess. By then, several trends collide. Refinancing walls for government and corporate debt intensify as low-rate bonds fully roll off. Interest costs push closer to levels that crowd out major spending categories. Global growth remains too soft to grow out of debt in the old-fashioned way. The dollar's share of reserves falls far enough that its dominance is visibly weakened. At the same time, central banks will have had years of heavy gold accumulation behind them, and alternative payment systems and trade arrangements will be more mature. The system becomes brittle, too leveraged to tolerate much higher rates, too inflated to pretend everything is fine, and too politically divided for painless fixes. In that kind of environment, shifts that once seemed unthinkable, new reserve baskets, gold-linked mechanisms, repriced assets, suddenly become necessary reforms. The label you give it doesn't matter. The effect is the same. The rules of the monetary game get rewritten, while most players are still playing by the old handbook. If this all sounds unprecedented, it isn't. The last major reset happened in 1971, when the U.S. abruptly stopped redeeming dollars for gold at the fixed rate that underpinned the post-war system. The reason was simple. There were more claims on gold than gold in the vaults. The math stopped working. Foreign central banks had spent years quietly trading dollars for metal, just like today's steady accumulation. As the gap widened between printed dollars and finite gold, the pressure became unbearable. Rather than lose all of its reserves, the U.S. chose to break the link. What followed was a decade of chaos: spiking gold prices, surging inflation, broken exchange rate arrangements, and social tension as living costs soared. Eventually, a new framework emerged, with floating currencies and the dollar still at the center, but under very different rules. This time, central banks are trying to get ahead of the chaos. Instead of waiting until the last minute to scramble into gold, they've been building positions for years. Instead of pretending the math works, they're adjusting quietly in advance. The pattern is the same. Too many promises, not enough real backing. The difference now is that more players see it coming. Here's the uncomfortable split. Powerful institutions are acting as if a major monetary transition is inevitable, while most individuals are still being told to stay the course and keep everything parked in the old system. Sovereign wealth funds, central banks, and large family offices are tilting toward real assets: gold, critical commodities, strategic land, essential infrastructure. They're trimming their dependence on long-dated paper promises and currencies whose value depends on political restraint. They're planning for a world where nominal returns matter less than preserved purchasing power. Meanwhile, the average saver is still being fed the same template: pile into conventional portfolios, trust that inflation stays tame, assume the currency remains stable, and ignore what the people at the top of the food chain are actually doing with their own balance sheets. You don't have the same tools or scale as a central bank, but you're facing the same basic reality: a system stretched to its limits and quietly re-gearing around hard collateral. When the world's biggest players spend a decade preparing for a storm, it's reckless to stand on the beach because the sky still looks blue. If you've made it this far, you're already ahead of most investors who still think gold is just an old relic and the dollar's role is untouchable. You've seen the clues: record central bank buying, shrinking demand for U.S. debt, rising fiscal strain, and a silent race to secure real assets before the next reset. You can respond to that in two ways. You can dismiss it, trust that they'll figure it out, and hope your savings survive whatever new rules appear in 2027 and beyond. Or you can start thinking the way institutions do, in terms of systems, incentives, and survival, rather than headlines and short-term moves. On this channel, we break down exactly that: how central banks are quietly rewriting the monetary map, what past resets teach us about winners and losers, practical ways individuals can position without panic or hype. If you don't want to be the last one holding assets priced for the old world, hit subscribe, turn on notifications, and stay with this series. You don't need fear. You need clarity, a plan, and enough time to act before the reset stops being a theory and starts being your reality.